As you know, we started topic 7 last month. It deals with determining the cost of goods sold, and this little video is a review to summarize what you should understand at this point. We looked at 3 different ways of determining the value of the goods that we sell, and that's an important concept. We're talking about a business like a retail store. That will be the example we use here. Those kinds of businesses buy their products from a supplier of one kind or another and then resell the items at a higher price. So when they sell the items, they also have to understand that it's important to determine how much those items cost the business originally. That's the whole point of topic 7. Businesses have a number of different ways they can do that, and we've looked at 3. One is called first in, first out, one last in, first out, and one the average value. I'm giving you an example here, and we'll walk through this to show an extreme example of how these different kinds of determining the value of inventory can make a huge difference in the gross profit that's shown on the income statement of the business. So I've given you some information on the screen, and we'll walk through this. In this particular business, this retail store, on the 7th of January, purchased 50 items for cash. And on the 14th, they again purchased 60 items for cash. And on the 21st, they purchased 40 more items for cash, totaling 150 different items that they will be selling at some point. And you can see, if you look at this information and this, you can see how much these items increased in value, which is a pretty extreme increase, but it'll show you how these different kinds of valuation will determine gross profit, as we said. So on the 7th, we purchased 50 items totaling $50,000. On the 14th, we purchased 60 more. This time it cost $120,000. And finally, on the 21st, we purchased 40 items costing us $400,000. So a huge increase in the cost. The total amount debited to the inventory account would be $570,000. Now, I'm not showing you a journal here, but the first step is to obviously put that information into the journal. Those 3 transactions on the 7th, the 14th, and the 21st will go into the journal and then into the ledger. And I'm showing you here in this tab on your screen 4 ledger accounts. On the 7th, we purchased inventory, so we debited $50,000 and we credited cash $50,000. The 14th, we debited inventory $120,000 and we credited cash $120,000. These were cash purchases. 21st, $400,000, and the credit to cash $400,000. So you can see that those have been journalized apparently, and now we can see that they are posted. One more item for our demonstration here. On the 25th of the month, we sold 30 of the items at $12,000 each. I'm not sure what these items are, but they're apparently pretty valuable. 30 items sold, $12,000 each. Multiply that out. We sold them for cash, and we received $360,000. So that also is shown in the ledger. On the 25th of the month, we debited cash because we received $360,000, and we see a credit to sales. And that would have been put, first of all, into the journal and now posted to the ledger. So that's the information we have. The task of the accountant is to determine what these 30 items cost the business, because that makes a difference. We use 3 different methods. FIFO means first in, first out. So this always involves an assumption. We assume in this kind of valuation that these 30 items represent part of the first things we bought way back here on the 7th. The first things we bought were at $1,000 each. So if that's what our assumption is, When we sell 30 of those items times $1,000, the cost of goods sold is $30,000. And to follow it over, ending inventory is $540,000. We'll see that in a minute. And the gross profit then we'll come back to in just a moment. But if we use this amount for cost of the goods that we sold, again, we sold 30 items. They cost us $1,000 each, totaling $30,000. The entry would be in the journal and then posted to the ledger, and that would involve a debit, if you remember, to the cost of goods sold expense account, and in the amount we figured for cost of goods sold, $30,000. So if that would be journalized and then posted, that would be debited, and inventory would be credited. Had the wrong number there. Inventory would be credited by $30,000. Okay, and you can see the ending inventory in that scenario is $540,000, and that's what we show back in the sheet. To find gross profit then, we would take the amount of sales, the total sales for the entire period, which is just this one sale of $360,000, minus the cost of the goods sold. So our gross profit is $330,000. Now, if we use LIFO for the same scenario, if we use last in, first out, it means that those items that we sold these items on the 25th of the month. We sold 30 items, and if we use last in, we look at the last purchase, and those items were $10,000 each. So the cost of goods sold would be the 30 items that we sold times the amount that they cost us. And in that scenario, because we're using last in, we use the $10,000, adding up to $300,000. Now, if we go to, let's take this out that we had in here earlier. If we use our cost of goods sold entry, and we use this amount of money, the $300,000, debit in the journal first, and then in the ledger, debit cost of goods sold expense and credit inventory, we see that a balance in inventory is left of only $270,000 because we used last in, first out. And that corresponds to what we show on this page of $270,000. And again, the gross profit here is the total sales, which is still the same. We use the same scenario here. We sold 30 items at $12,000 a piece, totaling $360,000. We subtract now the cost of the goods sold. That's how we figure gross profit. Subtract the cost of goods sold, and you have a gross profit of $60,000. An incredible difference between the first in, first out and the last in, first out. Now, why would that be? Well, different businesses use different methods for varying reasons, but the downside of using FIFO in this case is that our gross profit is probably way overstated. It looks like we made a whole lot of money, and that may look fine to us and to the owners. However, the employees may say, why don't we get a bigger piece of the pie? We should be getting paid more if you made that much money. If they use LIFO, again, probably the gross profit is understated. It's only $60,000. So that's going to cause a lot of problem with the owners probably if we use LIFO here. So the reason they're so different is because the prices went up so much. In less than a month, they went from $1,000 a piece to $10,000 each, which is very unrealistic, but I wanted to show you how drastic that change could possibly be. In this case, probably the best scenario would be to use the average cost basis, and we just learned about that. We sold 30 items. That didn't change. We still sold 30 items for $12,000 each, and the average of the cost of goods sold is figured by taking the total amount of all the things we bought, divided it by that number of 150 items, and if we divide that, we will get an average cost from January 7 through January 21 of $3,800. Multiply that out, those 30 items cost us on average a total of $114,000. So if we put that in our entry into the journal and into the ledger, 114,000 debited to cost of goods sold expense, and then a credit to inventory. You see that the balance is $456,000, which corresponds to what we're showing here on this page. And the gross profit here is the same amount of sales, because that is the same in every scenario in this case, minus the cost of goods sold, which we figured using the average method of 114,000 equals $246,000 for the gross profit, somewhere in between those two extremes. So the easiest method, fortunately, is the one that makes most sense, at least in this kind of a situation with incredibly rising prices. So we won't see FIFO and LIFO used all that much, but I want you to be able to understand how to calculate that. And we've had some problems with that, and you might see some problems on a test using FIFO and LIFO. And you should also understand how to use the average cost to evaluate our inventory. The key part of this is that when we sell something, we have to make some determination as to how much these items originally cost us. And in simple examples, it may not be that difficult, but if you're talking about a huge store with many, many items and many purchases every day, many sales every day, it becomes a little bit more complicated. So generally accepted accounting principles say that a business can use FIFO, it could use LIFO, could use the average cost method. There are others as well, but we're going to use just these three. Finally, one more point I want to make here is that we've been using in all of our examples a type of business that is a type of store, retail store typically, that buys from a supplier and then sells items at a higher price. So that's one kind of business. Another kind of business may be a business that manufactures an item and then sells it. They actually manufacture the thing. We had a couple problems with a company that sold t-shirts. So if the company manufactures the t-shirt and then sells it, that makes things a little bit different. So we're not going to do many problems with this, but I do want to show you this part of the screen. This is how the cost of goods sold is figured for a manufacturing company. And it consists of three things. And again, we're not going to have problems with this so much, but I do want you to understand these three things that go into determining the cost of goods sold for a manufacturing company. They have to consider the labor needed to manufacture the item. In other words, what did we pay the employees that actually manufactured the items? Not the administrators, not the president, not the secretaries, but the actual people who did the manufacturing. We need to figure that amount of labor, that cost. We need to figure the cost to us of the materials needed to manufacture the item. So if we're making wooden toys, for example, we have to understand how much that wood costs the business. So the labor is involved, the labor needed to actually manufacture the item, the actual materials needed to manufacture the item, and then something called overhead. Excuse me. Overhead is the items needed to manufacture the actual thing, the items. This is an estimate every time, estimate of the percentage of electricity, heating, and so forth that's needed in the manufacturing process. So these are the three items. You add those three up, you get cost of goods sold. Now, I want you to go back to your course page, and there are some questions to answer.